let's talk specifically about an entire sector, the banking sector of earnings. So we went into to earnings season. Banking sector usually always reports first. They'll report, then you get a lot of retail, consumer, discretionary, and then you'll usually get tech after that. And that's usually like a 3.5 week window. So first week here, we got banks. Banks, how did it go? Okay, so the morning of reporting, banks announced, hey, things look good. We're pretty happy with how everything looks. And all of their stocks popped like 3-4% right at the go, right? Pre-market, boom, up 3-4%. That was JP Morgan, Citi, Wells Fargo, all those guys. Then what happened? Then all of the analysts and people like you and me got a chance to actually read their financials. And my goodness, the stocks fell and finished the day down 1-2%. Now, why did that happen? Well, here's a killer tweet that pulls apart every single thing that happened on the earnings day a couple of days ago. Banking crisis update. Essentially, here's what's happening. Were their revenues up? Yeah, they were up a bit, mainly because JP Morgan inherited all of the assets of First Republic, who went insolvent a few months ago, and none of the debt. But with that said, what's happening is that all of their fixed assets that were already underwater, the very reason that First Republic, Silicon Valley, those guys all went under, the numbers are getting far worse. We did a video on this for Bank of America like a week ago. But let me read this to you, because this is all pulled right from their own reports that they have put out to clients right here. Let me just show it to you. Here is Citigroup's quarterly financial report. Here's JP Morgan's earnings financial report. Here's Wells Fargo. What I'm about to read to you is pulled right from those three documents. So he says here, the bank's reporting season has begun, and of course, JP Morgan, Citi, Wells Fargo all beat expectations, sending their stocks higher pre-market. However, when people started moving from reading the cheerful press releases to the boring and lengthy financial statements, bank stocks quickly pared their gains, and BKX closed down, which is a bank ETF, closed down 2.5% on Friday. What the hell did investors find in the financials that caused such a change of heart? Here are interesting things I have found so far. 1. JP Morgan's fair value loss on their hold to maturity debt securities book increased to $33 billion. And no, here First Republic has nothing to do with it. So when I say HTM debt securities, that's just the assets they hold to counter out all of the liabilities they have. I've had to explain this a lot. When you go to a bank and you put $100,000 in, that's actually a liability for the bank because they have to pay you interest. Therefore, they need to hold something back internally that will pay them a little bit of interest so that they can cover your deposits. And what they're saying here is that stuff that they hold back, that safe stuff, it's gotten so toxic and rotten that he's about to describe how this is happening to all of them. So JP Morgan's safety net has gotten more toxic by 33 billion, up to 33 billion total. 2, JP Morgan lost 900 million in their securities investments. What's wrong with this? These are peanuts for Jamie. What's wrong is that this is the 4th quarter in a row JP Morgan books a $900 million loss despite the ups and downs in the market. That's a bit too regular, isn't it? However, if we compare this figure with the decrease in the HTM balance quarter over quarter, JP Morgan has been selling those safety net securities at 37.5% and 20% discounts all year and the end of last year. This is starting to become more aligned with the swings in the market, isn't it? Part 3. Now look at point 1 and 2 together. Do you notice anything strange? JP Morgan estimates a fair value of their HTM securities only 8% below book value, but the price they've been selling their HTM assets is at a 30% discount. If we apply MTM, which is mark-to-market, to HTM assets using what the bank itself is getting from the market, JPM is carrying a $123 billion loss on their safety net assets. This is right in line with what we talked about last week on Bank of America. Bank of America was describing something very, very similar. They're at about just over $100 billion in losses. Now, fortunately, they're not realizing them at the moment, but if there was a run on those banks would go insolvent just like the rest have. Part 4. While at least JP Morgan still shares important data wisely hidden in the various footnotes, Citi and Wells Fargo don't bother to do so. However, from what they cannot avoid disclosing, we can easily see how both banks really push limits in terms of accounting acrobatics this time around. For example, yesterday I flagged Wells Fargo reported a $4 million gain for Q2 of this year related to their debt securities. Citibank did even better, looking at a $49 million gain. Both banks hold $500 billion of debt securities, and they're doing far better than Jamie is managing them. Yes, if you believe in Santa and unicorns. However, if you apply the same 30% discounted value Jamie is getting to, Citi and Wells Fargo, both banks might be hiding about $150 billion in losses each in their debt securities, those safety net securities books. What about credit losses? While JP Morgan and Wells Fargo increased their provisions by 28 and 40%, Citi provisions decreased by 8. Come on, Jane. However, none of these three banks still made any meaningful provision against their commercial real estate. Among them, I find Wells Fargo assessment is the funniest one. Quote, the vast majority of portfolio is institutional quality and with high caliber sponsors. So what? Are those commercial real estate loans guaranteed? No. Is institutional quality reassuring when filings for Chapter 11 are at Great Financial Crisis 2008 levels? No. So basically, Wells Fargo is telling us that $100 billion of commercial real estate loans they hold are, quote, good because they say so. Lastly, but not least, deposits at JP Morgan, including First Republic, $21 billion versus a loss of $11 billion for Citi and a loss of $9 billion for Wells Fargo. According to Fed non-adjusted data, large U.S. domestic banks as a whole lost $150 billion in deposits in Q2. Then if the net for the first three banks that reported is a plus $2 billion, it means the remaining out there lost $154 billion in deposits, right? Someone might have been bleeding big time then. So he finishes. He says, considering all that has been said so far, no wonder investors started dumping bank stocks yesterday. The bank ETF is down 20% year to date versus the QQQ up 40%. This is the equivalent of an F1 car leading a race without fuel. It's simply not possible for a car to keep racing without fuel unless you're playing a video game. Believing that you can do it in reality is equivalent to believing in Santa. If this is the beginning of the bank's reporting season, I foresee plenty of games and smoke and mirrors along with nasty surprises ahead, and not only for bank stocks. Well, my friends, what has happened since this was put out? Also, if you want to, this guy does another update that actually goes into even more detail. He finds even more mind-blowing data. He put this out just 5 days ago. So what's happened since then? Well, Bank of America is bleeding. Bank of America says one of the most important figures in Bank of America's second quarter earnings report Tuesday likely won't be included in its main press release. It's the size of the company's loss on huge bond portfolio, that safety net, will probably be tucked into the financial supplement. The portfolio of so-called held-to-maturity securities, which totaled $625 billion at the end of March, showed a loss of $99 billion. The loss reflects the drop in the bond market since that debt, mostly mortgage securities, was purchased, blah, blah, blah. Okay, so Bank of America is joining the party. What else? Did anything else meaningful happen? Oh, Goldman Sachs says, hey, things are looking good, but our profits did plunge by 58% in the last 3 months. Leash. Anything else happen notably? Oh, BlackRock. Wait a second. BlackRock? Yes. BlackRock had their earnings. BlackRock, the world's biggest asset manager, handedly beat second quarter profit estimates, but showed a slowdown in money inflows, sitting shares down about 2%. Now, this was just this morning, and I haven't seen anybody on Twitter had a chance. In fact, let's just check real quick. BLK. Let's do this. See if anybody has gotten that same type of insight. BLK. So this guy said, okay, I'm not going to make you sit here while I do this, but essentially this is happening across the board where these banks are watching the value of everything they have start to completely collapse. And then just a little cherry on top.
Well, we've got uncertain economic conditions that you talked about, heavy debt loads, and that's contributed to the highest level of bankruptcies in 13 years. In the first half of this year, 340 U.S. firms filed for bankruptcy, with the majority in consumer discretionary, healthcare, and industrials. Serta Simmons, Silicon Valley Bank, Bed Bath & Beyond.
So I'm going to pause that there. I won't make you watch the whole 2 minutes. It's a good little 2-minute clip, though. So just curious, what do you guys think happens to these banks' balance sheets when these various companies go bankrupt? Well, they wipe that debt clean. So what happens to those banks? Those banks are going to have to sell more of those safety net assets to make good on those bad debts that just got wiped clean. So what's going to happen? I have no clue, but it doesn't look good. People were talking about how amazing earnings are supposed to be, and it seems that the more time people have to just go slowly through these financials, these right here, it's the documents they're releasing to the public. When people are combing through this stuff, they're finding, oh my God, this is bad and getting worse and worse. So